Hi everyone, thank you for joining today's webinar. I'm just going to let everyone come through from the waiting room and then we'll begin. Hi everyone, thanks for joining today's briefing into the unknown China-UK market outlook for 2021. Before we begin, I'm just going to run through a quick bit of housekeeping. If you have any questions for our speakers, please do use the Q&A buttons on your screens. You can also use the raise your hand function if you'd like to put your questions to the speakers directly, and we'll look to unmute your microphone in the second half of the session. Whilst the presentations will be recorded, the Q&A and discussion will not be and will be held under the Chatham House rule. So during the Q&A and discussion, feel free to use the information received, but please do not identify the speakers or their affiliations during that session. I'd now like to hand over to David Sayer, who's the Vice Chair of CBBC and of KPMG, to start the session. David.
Just getting all the buttons working, hopefully.
Yeah, we can hear you loud and clear. That's great.
Marvelous. Okay, thank you as well, and Lisa. So thank you for joining us for what promises to be a wide-ranging tour de force of the macro trends and business landscape in China for the years ahead. So good morning to those joining us from Britain, and good afternoon to our friends in China. 2021 began for the UK as for the first time for well over 40 years as the UK as an independent trading nation, with trade deals in place with 63 countries and also now, of course, with the EU 27. It also began with the global pandemic decimating economies everywhere, with countries like Germany having to put up 50% in terms of their GDP in terms of fiscal stimulus. The pandemic is decimating economies everywhere, except for China and some other areas in Southeast Asia, where GDP forecasts fall in at around 8% growth for the year ahead. Which accounts for more than a quarter of global growth. And of course, China has been more than a quarter of global growth for the last 10 years. And that really is a reason in itself for businesses everywhere to focus a business lens on China. If you are looking for growth in this world, it is in China. And of course, the UK-China political landscape is a complex tapestry right now. And it would be wrong for me to suggest that business can ignore this. What we've seen, though, through a variety of proposed bills and policy announcements, the increased focus on China is creating some uncertainty. What I'd like to say, though, in the context of this discussion is that for all the geopolitics and the ongoing anti-China rhetoric, particularly in the US and to a degree in the UK, international businesses in China are absolutely thriving, and not least those from the United States, whose banks and financial institutions continue to lead the way in seeking licenses to operate in China across that sector as China continues to open up under the changing regulations. And any concerns about Chinese consumer nationalistic trends towards foreign brands whose governments are not viewed as China-friendly can be dispelled. The Singles Day analyses demonstrate that US brands were the biggest beneficiaries. The Chinese people are still buying US, UK brands. We have two terrific speakers today. Firstly, my old friend Mark Harrison, who is a partner in deal advisory in KPMG Shanghai, He has worked on over 250 transactions involving foreign companies in China in the last 12 years. Mark will cover the key macro trends for China's economy in 2021, which is the output of a recent KPMG report. And Mark will be followed by Torsten Weller, policy analyst at CBBC, who will give a high-level update on China's 14th five-year plan and key economic policies in the regulatory environment. When the speakers have concluded, this will be followed by Q&A, and please do submit those questions using the Zoom Q&A as Isabel has outlined. Mark, over to you.
Thank you, David. Good morning and good afternoon, everybody. Turn on my camera and share the screen. Isabel, can you just confirm for me if you can see that okay?
Yeah, you just put it full screen and then it will be perfect.
Yeah, just 1 second. Okay. Maybe just give me 1 moment, I'll introduce myself to the audience. So thanks, David, for the introduction. I'm a deal advisory partner based in Shanghai. I've been based here for the last 13 years, advising clients on deals here. Previous to that, worked in London and in Paris for a number of years. And my work here is mostly working for multinationals making investments or joint ventures here in China. So KPMG, we've recently written this new publication called 10 Macro Trends for China's Economy in 2021. This is an abridged version for today's presentation. We can send you the full report if that's of interest. Let's move on to the presentation. So,
sorry, Mark, could you just make it full screen, just the bottom right corner?
Sorry, but my computer's causing problems. I don't know if you can put it up full screen, but mine is not reacting.
Let me do that.
I close it. The first trend is more about what's going to be driving the economy in 2021. So the recovery in China this year has really been led by the industrial sector and by exports. And whilst we've had this, very positive and encouraging 2.3% GDP growth, there has been a lag of the consumer sector, which we've starting to see some positive signs. The hospitality sector turned positive in October. And going forward, we really think that consumer and service sectors are going to be the driver of growth going into 2021. One, I think, important caveat, as many of you would know, there has been a number of outbreaks across China in the last week, including here in Shanghai, which is creating some nervousness, as you can imagine. The number of cases are obviously significantly less than in the UK, but given the situation, the well-controlled situation we've had here for the last 9 or 10 months, this could create some uncertainty and economic volatility going in the months ahead. If you go on to the next slide, please, Isabel. So the second one is that we really see that advanced manufacturing will be a key driver. There have been some very positive PMI numbers. It's all been expansionary since last March, and the Caixin index actually hit a 10-year high in November. Many of you would know that the private sector is particularly important in China. It contributes about 90% of manufacturing investment. And the key thing going into 2021 is the 14th five-year plan, which will be announced in the next few months. And it's very clear that advanced manufacturing is going to be a key part of that. That's linked to the dual circulation policies. It's clearly desired to have a much more independent domestic economy in China, and that's going to lead to a lot of focus on investment in advanced manufacturing to really make it best in class in the world. Next slide, please. So the interesting thing is that whilst for many years people have felt that the Chinese economy has been over-reliant on exports, it's something that the situation of the global economy last year meant that China benefited a lot from the export of both medical supplies and also equipment needed for the at-home economy. So I imagine many of you are at home today, perhaps using laptops and cameras, speakers, etc., fitness equipment. A lot of that has been manufactured in China and exported overseas. It's really one of the deals I'm working at the moment is in the logistics sector, and logistics has really boomed in the last year in terms of both imports and exports. So at the moment, there's been a lot of questions throughout 2020 about what would happen regarding China, given the geopolitical situation, including involving COVID. And many people did wonder if we would see people leaving China. And that hasn't happened. We really see a in China, for China policy at the moment for many multinationals that I speak to here. They're very optimistic about the economy and are continuing to invest. The question that did remain outstanding was about what would happen involving sourcing. And we did a study on this late last year, which really showed that, in fact, whilst there has been some movement of sourcing to places like Southeast Asia, Eastern Europe, Turkey, Mexico, etc., in most cases, the companies doing that have actually found that these markets were not so reliable, didn't have the fully integrated infrastructure that China offers, and in some cases we're actually bringing their sourcing back to China. So we continue to see a lot of orders and a lot of order backlog for the companies here. You can see, obviously, in this graph, big growth in medical supplies, masks, fitness equipment, etc. Next slide, please, Isabel. Moving on to the fourth trend here, which is more about monetary and fiscal economic policy. You can see in the graph the size of the fiscal stimulus in different economies as a percentage of GDP, ranging from Germany with 39%, and at the bottom there you can see China with just under 6%. Of course, that is related to the fact that China was able to, control the virus within Wuhan and Hubei, and protect the rest of the country, such that they didn't need to have such stimulus policies or support of the economy and furlough, etc., that we've seen in the UK and elsewhere. Excuse me, my voice. And quite simply, I mean, recently the China Central Bank has said that whilst they expect 2021, the M2 and social financing will basically be in line with nominal GDP growth, whilst last year they were saying that they expected that to be significantly higher than last year, and that the actual fiscal deficit ratio, which had never exceeded 3% since the 1980s, was set at above 3.6% in 2020 for the first time. Clearly, we have to see what happens going forward. Given what's been happening here in the last couple of weeks, the situation is fragile, and there remain uncertainties. But fingers crossed that this will, the economy can prevail. Moving on, please, Isabel. So David mentioned in his opening remarks about the M&A activity, and we've seen a very, very strong inflow of FDI and M&A into China since the middle of last year. I think multinationals driven by the fact that they see a large, stable economy here that's providing positive GDP growth this year and going forward. There's obviously many geopolitical considerations. I'm well aware of that from following the international press, but when you talk to local MNC business people here, they remain very positive and keen to continue investing here. And as I said before, this supply chain question, we had anticipated some people would move sourcing overseas, but so far that's actually been quite limited. We think looking forward into 2021, we expect that inbound investment to continue. We don't see people leaving China. We don't see many multinationals seeking to exit their businesses. The only exceptions we see actually are with some Korean companies that have found that they have some legacy businesses that are not profitable, non-core, that they want to exit. Perhaps they would have done that anyway. I don't think it's directly because of COVID or because of the geopolitical situation. And I think moving into 2021, perhaps relevant to those of you in the UK, we do anticipate that China outbound investment will increase. Although a lot of what we've been seeing recently is more greenfield in nature and has been going into areas such as Southeast Asia or Africa and South America. There's been a bit less investment into Europe and North America than there was previously. Next slide, please, Isabel. So the renminbi, you can see this on the left side, the growth of foreign holdings of Chinese stocks and bonds. That particularly increased during 2020, I think in perhaps a slightly odd idea for some people, but saw China as a somewhat safe place to invest, given the economic situation here and the virus being relatively under control. We've seen that money coming into the country. In addition, China has continued to reform its financial markets during the year. So, for example, they scrapped the quotas on qualified foreign institutional investors, and they also allowed international rating companies to enter the market and removed ownership on restrictions on financial firms. That's been a particular active area. We've seen a number of the large banks, notably JP Morgan and Citigroup, have bought out their JV partners. So they now have full control of their China businesses, including securities trading. So there's been, as I said before, this interest in investing into stocks and bonds. The stock market here has continued to increase over the year, and there's now a 240 basis point difference between China and US 10-year government bonds. So going forward, we can anticipate that this will at least remain stable and perhaps some further modest appreciation as we go into 2021. Next slide, please. Now, there's been a clear correlation between the COVID situation in a country and the economic recovery. So in this graph here, you can see countries like China and Vietnam who are on the upper side of the dashed line, showing that they have above average recovery and relatively low numbers of confirmed cases, whilst the majority of other countries are over on the right side of the graph. Obviously delighted to see the progress in the UK with the rollout of the vaccine. Speaking to my friends and family, they're all relieved to see vaccines coming out. Here in China, this is a bit of a question mark. There are a number of vaccines that have been developed. There are at least 2 that have been quite widely used to vaccinate various, I think, people from the government, the army, etc., medical services, but they actually haven't yet completed phase 3 clinical trials. But there are countries around the world, I think including Bahrain, UAE, and the Philippines, who are using those vaccines. And there's now a gradual rollout of the vaccine, starting, I think, at the moment, and we really expect it to accelerate here in February. But clearly, vaccinating 1.4 billion people is a huge task and is going to take time. And we're waiting to see what other vaccines may be available. I have heard some stories that they may be importing some of the Pfizer or AstraZeneca vaccines as well, if people prefer those vaccines, but I suspect it will be in limited numbers. Next slide, please. So, of course, we had President Biden sworn in on Wednesday, and certainly the last few years of, I think it's stating the obvious, of US-China relations have been tricky, have been volatile, and both in terms of geopolitics and the trade friction. I think Joe Biden has signaled that he hopes to ease those frictions as he comes into office, but certainly the general thinking is that that's going to take time. We know that the conventional wisdom across Washington is that they will continue with the Trump era policies, and therefore it might take time to see particular improvements in those areas. One thing that you would be aware of perhaps is the passing of the Holding of Foreign Companies Accountability Act that was passed in the Senate last year, which we anticipate may lead to the delisting of some Chinese stocks in the US, and that may well lead to more listings in Hong Kong in particular. Next slide, please. So the next trend is to do with the RCEP agreement. So in late last year, the 15 countries signed that. That's been a lot of news and publicity around that in the region. People are quite excited about it. I think my understanding of it is that whilst it is a significant step forward, and it certainly includes, for example, the first time there's been an economic partnership between China and Japan and between South Korea and Japan, and it covers a number of things like tariffs, rules of origin, etc. It's significantly less ambitious than, for example, the European Union or the North America Trade Agreement. But it's clearly a step in the right direction. Those countries being able to get around the table and align themselves and saying that's what we want to do. And I think based on that, you can look forward into 2021 and see that the world is really going to revolve around these 3 trading blocks and free trade areas of RCEP in Asia, the EU, and then the North America Trade Agreement as well. Next slide, please. Just some final comments here. Really see a trend towards innovation, security, and green development. So in terms of innovation, lots going on here around AI, quantum information, integrated circuits, etc., etc. A huge amount of the deals work we're doing at the moment is tech related, especially for private equity, investing in health tech, education tech, agri-tech, etc., etc. I'd also particularly mention, I think, automotive as well. We're doing a lot of areas there. We know that the 14th five-year plan is going to be very focused on national security strategy, which is related to this new the twin circulation of the economy policy that we expect to kind of the dual circulation, excuse me, between the domestic economy and the external economy. And finally, some positive news that we saw with China promising that its carbon emissions will peak by 2030 and then striving to achieve carbon neutrality by 2060. This is a huge undertaking for China. I mean, it just cannot be reinforced enough how much will have to change here in terms of the power sector. And as a result, it's leading to a lot of investment already in renewables and the supporting industries, around solar panels, offshore wind farms, etc. These are all areas that we expect to attract investment going forward. So thank you. I think that's the end of the 10 trends. Just check the next slide. That should be the end. Should we, any questions now, or we hand over to Torsten?
Oh, we'll go to Torsten. That was great.
Okay.
Thanks, Mark.
Thanks.
Okay, hello everybody. My name is Torsten Weller. I'm CBBC's policy analyst. And just let me share my screen. Okay. Where is it? Okay. So Mark has mostly spoken about the economic macro trends. I'm going to focus on policy and regulatory trends. So I try to keep it very short, even though there's a lot to talk about. So maybe if you have some specific questions, then don't hesitate, and maybe we can discuss it in the Q&A later on. So I'm going to focus mostly on 4 points. Well, like Mark already indicated, so the 45-year plan will be a big topic this year. Then China's changing regulatory environment, where we've seen quite a few changes in the last couple of months. They're going to briefly talk about the EU-China investment deal, because there have been a lot of questions regarding the impact on British businesses of this agreement. And at the end, I try to address some of the global challenges that we kind of expect in the coming year. So, okay, let's start with the 45-year plan. Maybe first things first. So the 45-year plan was kind of outlined last year, the fifth plenum. It also included, at least the outline also included a long-term plan. So we have like these kind of two cycles in Chinese policy planning. So you have the 5-year plan, you have the 15-year planning, and 2020 was kind of the end of both the 13th 5-year plan and the previous long-term policy planning. So that's why we have this policy with the eradication of absolute poverty. So one question that existed prior to the fifth plan was whether China will keep a GDP target, and the answer is yes, it will keep one, although it has been moved into the long-term planning. So Xi Jinping indicated that he wants the Chinese economy to double in size between 2020 and 2035, and that would translate into like an annual growth target of around 5%. So that is not overly ambitious, and even if China keeps this relatively modest growth target for the next couple of years, then we might see China overtake the US by the end of the decade. But I mean, that is remains to be seen. So, but that is the current estimation. So, with regard to the content of the 45-year plan, there haven't been that much surprises, although there were a few kind of adjustments, like especially in the second half of 2020. So first of all, with regard to the self-sufficiency and the indigenous innovation policy, we are seeing that China has sort of admitted that it will need more foreign support for this, mainly for two reasons. First, it is actually lagging behind its own targets that were set in the Made in China to a 2025 strategy. So we've seen that in most of these areas, China hasn't achieved its the goals for 2020. So it needs to step up speed here to invest more in that. And the second reason is that it actually doesn't have the money to finance all these projects that that are going on in these areas. So it has indicated, like already in the negative list last year, and now with the EU-China deal, that it wants more foreign investment in these areas. The second big topic of the 45-year plan is, of course, the dual circulation strategy, which, in my view, boils down to domestic demand. So that is also something we've seen in the at the Economic Work Conference last December. China wants to boost domestic spending, and that is the actual challenging reform, because it would mean that you have to increase wages, you have to reduce costs, especially in real estate, education, healthcare. What I expect to see this year is that there will be some reforms with regard to real estate prices. We've seen some minor adjustments to the hukou system. So, for example, that people now can or expect to be able to apply for a social security number outside of their hometown, so in a different city than where their hukou is registered. But the real big reform, so like in terms of like pension reform or social welfare reform, where we really talk about more public spending, that will take some time, and we might see some debate this year, and we might see some initiatives, but I don't expect that to happen anytime soon, because it's just too difficult, especially as local municipalities like and counties who are responsible for these expenses, they simply lack the funding right now for actually doing this. So but it's going to be interesting. It's something to pay attention to. Then of course we have like the green development in the plan, where we're also going to see more investment and greater openness to foreign trade, especially in the service sector. That is also something that was kind of more prominently promoted last year, and we might see more of this like this year, so especially with like negative list for the service sector. So that are kind of some welcoming changes. Now, with regard to regulatory change, so there are two big topics that have been in the media recently. So the first one is the like the strengthening of China's anti-monopoly review system that has been going on for some time, but I think the failed IPO of Ant Group kind of has brought it to like international attention. The two things I want to really get across here. So the Western media has often kind of portrayed it as a kind of like as a crackdown on Alibaba, and that's not really the case. So and the second misperception is that it's kind of like, oh, it's like, again, like the state versus the private sector. I think that is a misperception, especially if you look at the size of these tech companies, right? They're comparatively much larger than any Western competitor. So you just and the fact that these companies have grown so big actually indicates points more towards the weakness of the Chinese state rather than its strength. So it's also not just about Alibaba. So Tencent has also seen some investigations and has been fined for anti-competitive behavior. But a thing that that worries me is that what we've seen with the Ant Group case is that although the regulatory logic is fairly similar to what we've seen in the EU and in the US now, maybe China's regulatory agencies like the State Administration for Market Regulation, right, just seems too weak to actually deal with that. And now we have like the People's Bank of China kind of issuing its own definition of monopolies. So there is some turf war going on, and it really depends on political support. And although we might see more measures, I mean, there is a certain level of uncertainty as to how they will be rolled out. So, I mean, we need to expect that we will have these abrupt policy changes and measures, and it will be hard to predict simply because it's not always following just a purely administrative or legal logic here. The second big regulatory change will concern data protection and online services. And the point I want to make here is that what we need to understand is that there is a general shift in China with regard to data protection. So there was a recent survey by Ipsos that found that in terms of the share of the population, there is many China has the same share of people that are concerned about data privacy as Germany, so which is usually considered to be very obsessed with data protection. And when you look at the opinion regarding like the data policies of huge tech companies, then China is actually ahead of Germany. So there's 81% of Chinese are concerned about like data privacy policies like by big companies, and that is really driving the debate in China about data protection and also the power of these big tech firms. So there is a clear public support for this, and we have now have a draft for a data protection, a private data protection law, which will probably be approved this year, although it might not enter into effect until next year. And this, from what we've seen and with regard to the content, it is very similar to the GDPR. So so just to give you like some indicator of what to expect here. We have also a debate about online taxation, which again mirrors the debate that we have in the West with regarding to online services, and it's just interesting to see how China will do that, because it might offer a template then for policies in other countries, including in the West. Finally, China now has an export control law, and we probably need to expect that they're also going to use it very selectively. So that is also something foreign companies need to be aware of. Now, the EU-China Comprehensive Agreement on Investment. So the first thing that we need to keep in mind is that it hasn't been signed yet. So we only have an agreement on the text. And from all that we know, it won't be signed until the first half of 2022. And we've also seen that there's quite a lot of opposition to the agreement from the European Parliament, which has to approve the deal before it can be ratified. So there is a lot of uncertainty with regard to it, whether it actually will come into effect in the near future. One thing that has been a bit neglected in the recent debate is that the original intention of this this agreement was to basically replace and update like the 25 current bilateral investment treaties that exist between EU members and China. So that was the original idea, right? So just combine them, update them, and then have a unified agreement on investment. It then kind of became much more politicized in a sense, like by the trade war and the debate about China's own human rights policies. And that's it kind of like has kind of like led to this, the criticism that we've seen. In the end, what I expect is that I think we will see what happens. So 1 year is a long time, and we're also going to have a different German government by the end of this year. But I think if in the end, if you look at what the EU would gain from not signing it, right, then there wouldn't be much kind of benefit except for kind of like making a point about human rights. As for the content, well, that being like the bridging view. So I mean, the German BDI, the lobby group for the industry, said that there isn't much new in it. And when you read Chinese, the commentary on the deal, then it also seems more that it was is seen as a symbolic agreement, which is meant to put pressure on domestic like companies and ministries to speed up the reform process. So that like the Economist has said that Liu He sees the deal as a kind of a tool, as a lever against China's SOEs. And it might well be that this is one of the key rationale in China. But there is also kind of, I think, the main benefit for British companies, so that it puts more pressure on China's own reform agenda, and which then kind of helps not just European companies, but like international companies in general. Okay, at the end, about the future challenges. So what do I expect? So first of all, I mean, we need to keep in mind that the pandemic isn't over. And although I think that China will be able to control its own outbreak relatively soon, even if it means that, that we have to expect some drastic measures in the near future. It probably won't be like until the second half. So I mean, I think they probably get it under control like in the next couple of months. The bigger question I think that we have to pay attention to is as to how it will affect the vaccine race, right? And China's own vaccine diplomacy. So China has promised to deliver its Sinovac vaccine to developing countries who can't afford the Western alternatives. But with an outbreak at home, we might see some change in the debate and like more pressure by the Chinese public to focus on Chinese citizens first before then actually exporting the vaccine to other countries. So that is one interesting area to pay again to keep in mind. So with regard to the new Biden administration, I don't expect much change, at least not in the near future. So we know that the new China team in Washington agrees with Trump's like main premise, although they disagree with his methods. So that's also what Anthony Blinken said in his statement, I think 2 days ago. where there is like a chance for cooperation between the US and China is like with regard to climate change. So Biden said that like fight against climate change is one of his top priorities, and he mentioned it in his inaugural speech, like just after the fight against racism in the US. And that will mean that he will have to engage with China, and that could also have an impact on UK-China relations, because currently, I mean, I think we have to be honest, the current approach with China in the UK is mostly driven by like security considerations and human rights. But if the Biden administration wants to make COP26 a success, so and communicates that to the UK government, that could offer an opening for easing of tensions, like in the second half of this year. So yeah, so overall, I expect that like the first half will be like of 2021 will be difficult, especially if we have like the B&O deadline, we have the telecommunications bill, the national security bill, and we have the debate about the Chinese embassy. But in the second half, as we approach COP26, there might be a change in the tone, and that might offer some chance for reviewing the relationship. Because if we look at the economic reality, then it's clear that a future UK trade policy can't ignore China. So you've seen it last year, right? UK exports of manufactured and consumer goods have increased 9% to China. So this is a big difference with regard to all the other developing countries where exports have declined. And China will, in the foreseeable future, remain the main growth market for UK exports, and that can't be ignored. And at some point, the British government has to kind of take this into account. Okay.
Great.
Now I think we're ready for the Q&A.
We are. Thank you, Torsten. And thank you to Mark as well. I think that was just a really great, massive overview of what's going on. And it's just such a big area at the moment. Can I just remind everybody that we are on Chatham House Rules. We're not recording the Q&A, so we'll keep that